The expected value for Q4 GDP is much lower than consensus.
Yep.
Without giving away the secret sauce, what is Old Wall missing with their models, even if they even have any, to expect so much higher numbers for GDP?
Well, it's pretty simple. I mean, the way that a traditional Wall Street or a traditionally trained sell-side economist would model something is using not only some kind of a regression model, but a deterministic model, and its assumptions are deterministic, whereas our models are stochastic. Look up both terms, you'll see the difference. They're actually quite different.
All right, another process question.
It's all in methodology.
Yeah.
So it's kind of like saying, you know, I don't get it. There's like blue paint, yellow paint, red paint, and that guy, Picasso's got a really good, how the hell did those other pretend painters not paint it like that? I'm not trying to say I'm Picasso. I'm just trying to give you a simple way to an obvious answer.
Well, I also think it's even simpler than that with a lot of people. It's like linear extrapolation. Like, so last quarter was 2% growth.
Yeah.
So this quarter is 2.1.
Oh, great example. I mean, look at, go to the slide 14, guys, where we actually have our updated nowcast of US GDP growth, I think. Yep. Look at this. Okay, first of all, a couple points to be made. Oh, geez, come on, bring it back one more time here, guys. Let me draw on this sucker. Okay, so let's use the proper color coding. On the way up, and again, all of our subscribers from the last 3 years at least, and for those of you who've been with me for the last 10 years, thank you. Sincerely, thank you. The only reason why we can produce this type of content is because you're paying us, okay? But this acceleration in GDP growth, just call the big picture right. There was no firm that had higher GDP forecasts than us. You know what Wall Street's forecasts were throughout that period? That GDP would be right around down here. It would just stay there. 1.5%, 2%, slower for longer. The data told us we'd have upside surprises, and now the data is telling us we're going to see a huge downside surprise. Where's Wall Street? Well, actually, these forecasts, these Bloomberg consensus estimates, are now at 2.5, but they used to be at 3 because the prior number was 3. So again, they're linear extrapolations of what happened yesterday. That's why you should not use the old wall. That's why a lot of buy-siders, like Howard Marks in particular in his latest book, says, are you crazy? Like, would you use a sell side or an old wall forecast? That doesn't help you at all. I agree with that. I don't agree that Howard Marks knows what we're currently doing and building here, and I do know that it would certainly help him and it would open his eyes to how we're front-running what he doesn't believe works, because it doesn't work. So again, Wall Street consensus does not work. Its only value is in fading it when you're on the other side of it. And that works obviously both to the upside, when we're far more bullish than anybody in terms of our nowcasted forecast for US GDP growth during the peak of the acceleration and throughout, or on the Q1 or on the January 30th number, which will be the first major deceleration.